Today, a thirst for liquidity. Hello again, it's Martin North from Digital Finance Analytics, working latest post covering finance and problem news with a distinctively Australian flavour. Today, I'm joined by Tim Fuller from Nucleus. Well, hi Tim.
G'day Martin, how you going?
Yeah, pretty good, thank you. Yourself?
Very well. Out of lockdown tonight, so it's all happy days until the next one. Yeah. But anyway, we'll hang in there.
It is a bit like that, isn't it? But anyway, great that you spent some time with us this afternoon. And this is the next conversation around our L's, right? And so today we're going to talk about liquidity.
Absolutely, yeah. So one of the crucial, I think anyway, one of the crucial L's in the L series, and it probably isn't, people don't really think too much about it until you get to a stage in your life where liquidity matters. And what I mean by that is Australians, obviously, as your audience knows all too well, our preferred measure of or lever that we pull for investments in this country is property, which is incredibly illiquid. So whilst for many years, it is a major investment concern or investment thought for people. One of the key areas where it is sadly lacking, of course, is its ability to be liquidated quickly, and that's where, of course, it becomes time to start looking at other options.
Right, and this is the old concept about you might be asset rich, but from a cash flow perspective, you can't access money when you need it, and that could cause a problem.
Too right, that's right. Yeah, look, we've spoken a little bit about it and covered off in some of the previous L's, but looking at your cash flow is a crucial part. And I've got in the article I've written this week, cash flow is king, but liquidity is queen. And I think that's an apt statement in the sense that when you're looking at the amount of return that you need from your investments, it's easy to have a look at the income figure, I guess, either through dividends or distributions or rental income for that matter. And obviously people do use investment properties for income sources in retirement. But the issue then lies in what happens when your cash flow needs actually overrun the steady liquid income that's coming in from these sources. And then you start having to look at things like selling down assets in order to fund that gap. And that's where all of a sudden liquidity really starts to matter.
Yeah, absolutely. And of course, sometimes you get these, crises. For example, suddenly, nobody wants to take a rented property, and so your rental stream drops, or the dividends get cut because of an international financial crisis, as we had last year. And so even the cash flows that you think are certain may not be quite as certain as you sometimes think, and that can cause some issues too.
Oh, look, for sure. And one of the big problems is that when you do get severe market volatility, you start getting what's called correlation across all of your various assets. Some, to certain degrees, a lot worse than others. But what it can mean, though, is that you're either forced to sell, if you can sell, of course, at poor prices. Or it may actually, you may find that the fund or depending on the underlying asset might actually lock up and just be unable to be sold for a certain period of time. And we've seen this, time and time again. And I guess this is why it's a crucial component and why we've brought it forward for people to think about when they're building portfolios and ensuring success in their retirement.
Right. And the point there is that there may well be uncertainties that you need to navigate. And, who would have predicted the pandemic over the last year plus, right? But it has had a big impact on people. And of course, the other thing that's happened there, interest rates have got very low. So even returns from term deposits have fallen through the floor as well. So a number of people that in my surveys have actually been caught out by all of these movements in returns which have dropped. And yet, of course, they've still got the same money going out the door in terms of commitments they've made, commitments they have to make just to keep food on the table and pay all the other bills.
Absolutely, Martin. And I think that's where shows like yourselves and people doing work around educating people around the investment space are doing a fantastic job, because at the end of the day, people are now having to reach into risk. So term deposits aren't paying much. Bond portfolios are struggling a little bit as well, obviously, in the low yield environment. And it becomes a pretty uncertain sort of area for a lot of people to then go looking for other investment options. And look, there's plenty of them out there. But what you've got to have that view on is, am I going to be able to get this realised, at a time that I need it? and what sort of pressure testing is there if there was to be a big market, big piece of market volatility or a market crash? What's the outcome for this particular investment? Is it going to be able to be sold? Is it going to lock up? And therefore, should I be expecting a slightly higher rate of return than I would otherwise in what you call an illiquidity or a liquidity premium? The harder it is to sell when it's problematic, then the more you should be getting for it along the way.
Right, and that it becomes ever more important, when you don't have the same flow of income from working, right? So when you stop work, because then you'll rely on some of these other sources of income. And I like the idea of running scenarios and, playing devil's advocate a bit. What would happen if, and then doing a little bit of testing around that to see what the right formulation would be and how you're best protected.
Well, that's right, for sure. And I've popped in the article as well that obviously when you're working, your time is effectively the asset that's somewhat being liquidated, and it's just a paycheck away. So it's pretty easy to not worry too much about the liquidity side in working life. But of course, where it is very important is when you're relying on your assets for that income piece. Look, for mine, not saying illiquid investments in totality, should be avoided at all costs, but you need to really be able to run the ruler over what you can sell in times of problematic market periods, for example. That's often when you need to access money quickly, and things aren't perhaps paying, as you mentioned before, dividends are being cut. And there's there's just problems throughout financial markets, and so having to being able to hit the sell button and actually being able to sell for you, whilst you may or may not actually need to do it at the time, it's about probably also just thinking through your emotional state, and I know, and I'm sure your listeners have seen many times that the issues that come from when assets effectively get locked up in times of market duress, and of course the emotional effects that flow on from that, which is never a great position for anybody to be in their portfolio, particularly if they weren't expecting it.
No, that's right. And the point, of course, is that nobody quite knows how things are going to play out. But what you really want is some assets that are relatively easily accessible and relatively certain. You may have to forego a little return on those, but at least they're there and available. And then you have another pot which is slightly less liquid and hopefully gets you a slightly bigger return, then a bit more with a bit more return and a bit less liquidity, right? So you build a bit of a sort of a structure around it. Now that process, I don't know what you think, but I think that a lot of people don't go through that process very adequately and often end up with just grabbing the easy stuff and not necessarily thinking through the what happens if, right? And the other point is you want to avoid having to sell into a crisis. So, for example, if you had all your funds in stocks and shares and the markets crashed 30%, the last thing you want to have to do is to sell into the bottom of the market to release capital because everything else has gone wrong. So again, you've got to be thinking about what happens if, right? And that ultimately seems to me is what that financial planning element is about.
Oh, look, absolutely. And that's part of a professional having experience in markets, and more often than not, their clients coming to them for, to harness some of that experience. But you're spot on in terms of looking at buckets, both from a risk perspective, how much risk is, in terms of market risk, volatility, am I happy to take on board, and what sort of time frame would I need to get back? And obviously, the longer that you can leave money in the markets, the more risk that you can take on board. But also having those short-term cash flow and lifestyle areas of your portfolio that you can draw on. They're highly liquid. Sure, you probably won't get much return, particularly in times like now, but at the same time, that's what you're giving up in order to make sure that it's there at the right time and maintain your lifestyle and keep you going, essentially, keep a roof over your head and ease the emotional burden of volatile market periods.
And that means that you need to understand what your likely commitments are over, a 3-month, 6-month, 9-month, 12-month period. So you've got a sense of, well, if all else failed and the income stopped coming, what would happen, right? And that also suggests probably you'd have some emergency funds that were available somewhere that you could pull on if you really needed to.
Oh, look, absolutely. And making sure, and time and time again, particularly if people go to, advisors, one of the first things they say is put some emergency or rainy day money in, in something that's very, very liquid or cash-like, that is there. And part of that is obviously for in the event of emergencies, but it's also about just maintaining some confidence, in the rest of your planning, that you've got this bucket sitting there, and it's always available. One other one actually just jumped into my mind there, and is the use of or the ability for some people to chase higher returns, from certain market instruments. And I'll give you a good example is bank hybrids. So, they're often sold predominantly to retail investors. They carry the bank's name and often, and obviously, higher rates of interest per se, or, the coupon payments. So they're available, on the Australian Stock Exchange. And look, I don't think there's anything wrong with them. But what you've got to be careful of is in periods of market volatility, and you see this all the time, the actual value of those hybrids does fall, and that's just the way that they sit in the capital stack, sort of between debt and equity. So they kind of feel like you've got sort of debt levels of risk, but they can behave like equity in volatile periods. And for a lot of people, that comes as a big shock. And it's just another part of that liquidity piece that you've got to really sort of dive behind, and also just have a look at the way they behave in like any investment, the way it behaves in problematic times.
I know your point there is read the small print, right? Get to understand how they work, and particularly with those hybrids, what might trigger their conversion from one type of behavior to another type of behavior, right? Because actually that trigger point could be precisely a financial crisis.
Well, that's right, and that's sort of the delicate tightrope that you can walk on some of those high yield paying bank and corporate hybrids. Look, as I said, they're not widely used in the sort of financial industry outside of the retail investors, so it's probably a little bit telling. But by the same token, if used well, I guess in a balanced portfolio and also risk adjusted and liquidity adjusted, they probably have a place for some people.
And I guess the last point I want to make was that you can't just leave this liquidity planning question until you've retired, right? What you should be doing is laying the foundations in the years before retirement. So in other words, you build your asset portfolio structure with the conscious thought about liquidity in retirement. So it is part of the ongoing journey of planning for retirement rather than making that decision once you've retired.
Oh, absolutely. For most people, they think about retirement, with years and years ahead of them to put the right sort of assets and portfolios in place. But then they're also retired for a long time as well, and so they can still take advantage of risk markets. What you don't want, though, is to get your fingers burned by being in some instrument, or and quite often you see this in real estate funds as well, where you get big shakeouts in the market and they lock up, and it scares you away from the whole thing. And so then you go, all right, no more market exposure for me, never again. I can't deal with the emotional side, and you actually then miss out on everything else as well. So
yeah, and that's why appropriate fund structures actually become quite important in this, right? Once you've done that piece of thinking. And I guess, that's where people like the Wealth Fund or Nucleus Wealth or whatever can provide some expertise and some solutions in terms of helping to think it through. Once you've done that initial thinking yourself. But that is the point. There is a piece of thinking that potential individuals need to go through to be able to get the best investment strategies that you possibly can.
Absolutely, Martin. And look, as the old saying goes, there's no such thing as too much information. Look, ourselves, or going to see an advisor, or our no obligation onboarding portal that we've got, we'll give you something. We'll give you a portfolio, and obviously we can tailor that through the risk profile. You don't have to take it, but you can take it as one of the many options that are out there, and help you to essentially see what's in the available in the space, and further your knowledge on what a portfolio looks like through us. Obviously, we use quite vanilla, I guess, levers, as you know, in cash, bonds, and large cap equities, and we're happy with that space. We think we can do what we can, and of course, it is highly liquid.
Well, that's pretty useful. And Tim, you've published the corresponding article for this on the Nucleus World website. We'll put the link to that below. It provides a bit more information, a few other links and things. And I would recommend that people go back and look at lifestyle and longevity, right? Because they were the other L's. So, is that the sort of the complete story, or is there another L to come yet?
One more to come. We've obviously had a bit of fun with lifestyle. We've looked at the longevity piece, of course, and today with liquidity. The final L is legacy. So looking about, running through some ideas and thoughts on what can happen post-retirement, if you know where I'm going. Look, it's an interesting part, because more often than not, when I speak to people, there actually is a degree of legacy in what they do, particularly if you're speaking to someone fresh, I guess, that, they just sit down, they go, okay, here's what I want my retirement to look like. And then here's what I want my legacy to look like. Here's who I want to help. I want to make sure I've got blocks of cash for various members of my family. Maybe not all of them, but anyway. So it's an interesting part, and I think it'll sort of capstone off the pieces that we've been doing, Martin.
Yeah, it is important, and that takes you into things like wills and those sorts of things too, right? Which is an important part of the overall architecture of good financial planning. So I look forward to picking up with you again and get the fourth L knocked down, and then we'll have a final song of Noel, right?
Who knows? Well, I'm sure we can find something else to talk about, Martin. It's always great chatting with you, and of course chatting with the members that come through the Walk the World Fund from your channel.
Tim, I appreciate that. Appreciate your time today, and we'll talk again soon. Take care.
Excellent. Good on you, Martin. Cheers.